My name is Siti Hajar binti Khairuddin and number matric is 06D8023F1001.
My name is Faradiana binti Salami. My matric number is 06D8023F1025.
Hi, my name is Noor Namasha binti Zahidin and my matrix number is 06D8023F1043.
Hi, my name is Tanisha, daughter of Maniwanan, and my matrix number is 06D8023F1040.
Hi, my name is Muhammad Amerika Rubi Ahmad Shukri. My DAT number is 06D8023F118.
Farah, I just got an assignment about non-current liability, but I don't know the definition of it. Can you explain it to me if you know about it?
Yes, I can explain for you. Non-current liability are a long-term debt a company must pay after 12 months, such as loan, bonds or leases. They are important in financial analysis because they help measure company solvency, its ability to pay a long-term debt. Why is matter? Show how stable and financially healthy a company is in the long term. The second is used by a lender and investor to decide if the company is safe to fund or invest in. The last one is help its financial planning and managing future obligations.
Today, I want to present about type of non-current liability. Before that, I want to show you the accounting cycle for non-current liability. It is the same as like the type of non-current liability. So many types of non-current liability. It is such as long-term loan. Long-term loan is borrow money that must repay over a period longer than 1 year. For example, is business loan from a bank. Second is bonds payable. Bonds payable is debt issued to investor that a company must repay interest after a set time. Another type is lease obligation. Lease obligation is long-term payment a company owns for a used assets like a property or equipment. Credit line is an agreed borrowing limit that can company use a repay over time, often extended beyond 1 year. What is not payable? Not payable is writing promises to pay a specific amount of money in the future, usually with interest. And the last one is deferred tax liabilities. Deferred tax liability is a tax on that we are postponed to future accounting period.
You okay?
Yeah, I'm just a bit confused about the accession. Can you explain it to me?
Yes, of course. Accession in audit has 6 types. First one is classification. Classification is transaction and event have been recorded in a proper account. For example, wages paid to the worker should be recorded in salary expenses, but they recorded is asset region. Number 2, occurrence. Did the transaction really happen? For example, sales recorded must be the actual sales, but not fake invoices. Number 3, completeness. Are all transactions included, nothing left out? For example, all expenses incurred must be recorded, but not hidden. Number 4 is accuracy. Are amount correct and recorded properly? For example, if sales are Rm 10,000 ringgit, it must not be Rm 100,000 ringgit. Number 5, cut off. Are transactions recorded in the right accounting period? For example, December sales must be recorded in January. Okay. Number 6 are presentation. Are the items shown in the right place and in the right way in the financial statement? For example, loan shown under non-current liability but not under revenue. That's all. Thank you. Masha.
Yeah.
Do you know what's the difference between business ratio liquidity and non-current liability?
Sure.
And business values?
Okay, sure. I know the difference about it. For the first one, liquidity is
to measure ability to pay short debts. But for solvency, it is for measure ability to meet long-term obligations. Accurate figures are crucial for reliable financial analysis. But for non-current liability, affect solvency ratios used by lender or investor. The second one, impact decision on funding and investment. The third one, accurate record will. Did you know there is 5 purposes of non-current liabilities? The first one, used to finance long-term investment like property or equipment. The second one, help manage company cash flow by spreading repayment over time. The third one, supports business growth through borrowing. The fourth one, may provide tax benefit, example such as interest deduction. And the last one, improve credit profile for future financing opportunities.
Isha, can you discuss about the accounting system and control activity but relate to non-current liabilities?
Sure, why not? Accounting system and controls for non-current liabilities. Non-current liabilities are usually a long-term overdue for more than a year or more than 6 months. Secondly, it is recognized when obligation exists, measured at fair value, updated via amortized cost. Thirdly, it is different liabilities follow specific standards. And fourth, presented separately from current liabilities with clear breakdown in financial statement positions. And next, its internal controls include approval process, segregation of duties, regular loan checks, and proper documentation. For the last, it is audit helps detect errors, disclosures in notes include amount, overdue date, interest, and risk for transparency.
Hi, thank you.
Hey, Haja, wait.
Yeah.
I'd like to explain more about non-control liabilities, about its procedure. Do you know there are 4 non-current liability accounting controls and systems? First, it is standard MFRS for loans and MFRS 16 for leases. And second, it's measured at fair value and updated. Third, is recognized when obligation exists, payment likely and amount can be estimated. For the last and fourth, it is financial statements must disclose amount, due dates, and interest and related risk. For next, wait, I'd like to ask someone, but who would I like to ask? Amir!
Today I want to present about 6.3. Provide the discussion on the accounting system and control activities related to non-current liabilities. Accounting system and control for non-current liabilities. It's a non-current liability. Non-current liabilities is a long term. The debts due after 12 months. That means it's not single in the short term period. It's in the long term period. Recognized when obligation is measured at fair value, updated via amortized cost. It's have a amortized cost is like disposal cost. Different liability follow the specific standard. Presented separately from the current liability with a clear breakdown in financial statements. Internal controls include approval process, segregation of duties, regular loans check, and proper documentation. Audit helps detect the error. Disclosure in the notes include amount owed, due dates, interest, and risk for transparency. That means the auditor help the company to determine that the loan or any debt that he has a loss or they can pay. Next is 6.4. Apply the audit process by evaluating the evidence provided, recommend to support the assertion and accounting treatments, non-current liabilities, and accounting control. Standard MFRS 9, loan and MFRS 16 lease. Measure at fair value and updated. Recognize when obligation exists, payment likely amount can be estimated. Financial statement must disclose amount due date, interest, and related risks. Next, 6.4. Apply the audit process by evaluating the evidence, provide recommend to support the assertion and accounting treatments. Auditor must verify the valuation of non-current using correct standards. Loan record at fair value that adjusted using the effective interest method. List must reflect the present value of future payments. Auditor check contract calculation, discount rate, and gather evidence. Goal ensure liabilities reflect through financial operation and are fairly represented in the financial statement. And last, non-current liability record in the balance sheet. Organize your balance sheet. Choose the group by client or by type of liability. Help track who owes what or what type of debt is owed. This is make your company is more organized. The source of document. Enter the payment amounts. Record total owed for each category of long-term debt. Double check accuracy and match with document or expert confirmation. This is make you less mistake that you do when you record the amount. Compile the total. Add up all non-current liability, use formula or manual calculation, ensure the accuracy for reporting. This is an example for source document, long-term loans, and bond payable. That's it. Thank you from me.